Okay, welcome to another video, and in this video we're going to be going through the weekly S&P 500 ChartStorm. This is a weekly tweet storm that I do on Twitter, picking 10 charts from around the web. Often put a few of my own in there if I think they're particularly interesting, or if I haven't found enough from other sources. And by the way, if you have any suggestions with charts that you want to submit, just at me on Twitter. Got the address there. Right, and before we dive into the latest edition, just a quick word here. The www.theweeklychartstorm.com. You can go there and sign up to receive the ChartStorm by email. It's a new feature that I've just sort of trying out. So go ahead and sign up and let me know what you think. Alright, well, first chart. This chart shows the annual maximum drawdown by year. Now, maximum drawdown is the largest negative percent change from the highest point, or the previous highest point. And really that's just showing how deep the biggest correction was for that year. And you can see a few standouts if you sort of have a scan across 1987, 2008, 1930s, etc. And really the reason for including this one is, as you can see, the year-to-date figure. It's actually, I think that 94-95 period was slightly lower, but it's looking like it might be one of the lowest max drawdowns in history. So it's just another illustration of how extraordinary the current market environment is. Would note though that it's year-to-date figure, and that could change substantially in the next quarter. May or may not. So chart number 2, very similar line of inquiry here, and this is again annual figures, and it is the average daily absolute percent change. So for example, a -1% and a +1% would be counted in common terms in order to get the magnitude of the the average daily magnitude of price change. And you can see there that it is about as low as it gets. Only in the 60s was it lower. Again, this is the year-to-date figure, and if we got a bit of fun and games in the last quarter of the year, that could change the picture here as well. And speaking of sort of near-term outlook, I've got this chart here which is kind of on a similar track in terms of volatility. It uses the VIX and the VXV to VIX ratio. VXV is medium term, so it's basically an indication of the slope of the futures curve. And we can talk about the mechanics, but if you just look at the chart, you can see there that there's a fairly obvious correlation there, that whenever it sort of spikes down, that tends to line up with market bottoms or climaxes of fear, and vice versa. I mean, it is one of those indicators that are better at picking bottoms than tops, but the fact that it is up at this upper range, if that lines up with another signal or another set of signals, then it would tend to be a little bit more meaningful. And I think it is certainly something that is a meaningful signal at this point. So on to the next one, seasonality. We had this sinister September seasonality, which really actually didn't show through. So the market has just carried on through, and the rest of the year typically tends to see positive seasonality. It's important to note that seasonal patterns are just historical averages, and a lot of the times they'll be the majority of the time returns were positive, but then, there's a decent chunk where they were not positive. Another thing to note there is that October, on average, is positive, but, within those averages, October is actually a unique month in that it has the highest, best, and the lowest, worst return on record and the highest standard deviation. So October is a wildcard month, and I can just think of a couple of things that would make you think that it could indeed be a wildcard month this time around. You've got the Fed just about to start its quantitative tightening program. You've got, potential disappointment or wrangling around US political risk and, quite a bit going on there. And of course, geopolitics, North Korea, etc. So, that's what's happened on average. Will we get that? Maybe. And sticking with seasonality, I wanted to show this one because I thought it was quite interesting, just how the US dollar sort of shares a bit in common with the S&P 500 around this time of the year. They tend to both get their second wind around this time of the year, so think about the US dollar, that could give it a bit of a boost over the coming months, and in line with the market itself. On to the next one, the euphoria meter. Now this one combines three different indicators, with three different types of indicators too, to give an overall view of the level of euphoria or otherwise. And you can see here it includes forward PE ratio. Now, forward PE ratio is a valuation indicator, but it's also a measure of confidence. Higher confidence in the outlook means higher valuations. Low confidence in the outlook, low valuations. The black line, bulls, that's bullish sentiment from the AAII and the II surveys. And it's combined and smoothed, and the same thing with the VIX. The VIX is smoothed there again as well. You can kind of see that. And the VIX is inverted, and essentially that's, when the VIX is very low, it's a sign that things are fairly complacent, and when it's very high, it's a sign of fear, which is kind of the opposite of euphoria. And when you get those combined, you get that red line there, and it's just moved up to a post-crisis high, and the highest point since the early 2000s there, 2003. This one's quite a cool indicator. I think it was quite helpful in calling the bottom in 2016 and actually flagging that little correction or series of corrections that we had there. And there's two things to look at when you think about a sentiment indicator like this. One is when it gets to extremes, and the other is when it gets to an extreme and pulls back. It hasn't really pulled back yet, so it's not giving that kind of signal, but the fact that it is high shows that there's a lot of confidence. And as I said, I think another few times, is that when confidence is very high, it means that expectations are high, and it means that the consequences of the expectations not being met are also high. So another one to add to the mix, another piece of the puzzle. On sentiment, this is a institutional investor sentiment gauge from State Street, and it shows the level of confidence or otherwise amongst institutional investors. This is North American investors, and I said here that they appear to be reluctant bulls. They're, yes, net allocating to equities, risk assets, but not aggressively so. And one reason that they're probably not aggressively allocating is this valuation picture. The trend is their friend, so they're still allocating. It's not much alternatives, but then not going to go all in when you see valuations this high. The orange line there is a sort of a unique way of looking at it. It's a percentile rank, so it sort of ranks it against history. And the experience has been that whenever it gets over the 90th percentile, typically in very overvalued or bubble territory. So technically that would put the current environment in bubble territory. And I sort of remarked in a comment there that you know, valuations do obviously, you know, pretty objectively look high, but I don't know, it just doesn't quite feel like a bubble. But then I suppose, you know, you go back to this one and you look at where the euphoria meter is, and well, maybe it is a bubble. I guess one counter argument to that is this indicator here. It is the earnings yield for the S&P 500 adjusted by inflation. I'm not entirely sure of the merit of this one, but you know, the signal that it is giving is that this measure of valuation is about, you know, it's just tracking around its long-term average. So, you know, if you wanted to present a counter argument against that high valuation one, that would be one angle. Another angle that you could take, not shown here, is against bond yields, which still remain pretty low. And you know, if that was one argument that valuations aren't that high, the next one is an argument that they are excessively high, exceptionally high. So this is price to book ratio for, and it's the average for cyclical sectors and defensive sectors. The black line shows, you know, for the cyclicals, it's basic materials, industrials, technology, and on the defensive side, it's telecoms, utilities, and healthcare. Utilities have had, you know, they're looking by themselves very, very high valuations, and that's, you know, partly, well, probably mostly a product of that push for yield. But you know, you look here, there's quite a bit going on really. So first of all, the black line is at very high levels, same levels that it got to previous to the financial crisis at the height of the dot-com boom, and you know, it was on a different scale back then, but it also ran up very high in the lead up to the 87 crash. And even looking at the blue line, it's pretty high by its own standards. You know, it's currently at the highest level it has been since the dot-com period. And then finally, the last thing going on there is the relative valuations, which is the red line, and that's showing cyclicals as you know, very richly valued versus their defensive counterparts. And why would you look at cyclicals? Why would you care about cyclicals? Well, of course, you know, aside from the trading opportunities there, you know, if the market does roll over, if we go into a correction or a bear market, the cyclicals are probably going to be the ones that are going to go first, or certainly fall the most. And so, look, that's it for this session. The other thing to note is the write-up over on Seeking Alpha. I'll put the link to that in the YouTube video information section, so you can go have a look there. I'll put a little bit more there in terms of conclusions and well, it's really a written version of what I've just done here, isn't it? So look, that's it for now. If you like this, then go ahead and subscribe to the channel, or indeed, of course, go and sign up for the email newsletter of the ChartStorm. And of course, like the channel, I'll be putting out another video later this week. Haven't decided what yet. Something macro, something global probably. So stay tuned for that.